Pakistan, a country with rich history and culture, but facing an economic crisis that seems to have no end. The country is now scraping by on foreign loans with sky-high interest rates and is staring down the challenge of repaying a staggering $80 billion in just the next 3 years. Its GDP per capita and economic growth are the lowest in the region, only doing better than war-torn Afghanistan. The most painful part has been inflation. In 2023, it peaked at 31% and is still around 30% in early 2024. This has made it incredibly hard for the poorest, who make up a third of the population, to afford basic necessities. Pakistan's import-heavy economy took a huge hit when commodity prices soared after Russia invaded Ukraine in 2022. Then, cutting fuel subsidies, a condition for IMF loans, made things even worse. Social media is flooded with images of recent food stampedes, sparking deeper questions. What kind of economic crises is Pakistan currently facing? What are the underlying causes of these economic crises in Pakistan? What do these economic crises mean for its people in Pakistan? You might be thinking, what's new? Hasn't Pakistan always been struggling? Well, yes, but this time it's a combination of crises all happening at once. First off, their foreign exchange reserves hit rock bottom in early 2023, scraping by with just $8.2 billion US. This amount was just enough to cover the country's import expenses for just about a month, far below what's safe according to the IMF's requirement standards of 3 months import coverage. And if that's not enough stress, Pakistan's staring down the barrel of a whopping $73 billion US debt bill due by 2025. A big chunk of that debt is owed to heavy hitters like China and Saudi Arabia. Imagine having to pay off a mortgage the size of a small country's GDP. Now let's talk about the Pakistani rupee. It went from being a hopeful contender for the world's strongest currency in October 2022 to hitting rock bottom by February 2023. This devaluation hits hard, especially on crucial imports like fuel, edible oil, and pulses. It's like your paycheck shrinking just as your bills pile up. GDP growth slowed to just 2.5% in 2019, and even shrank by -1.3% in 2020 due to the COVID-19 pandemic. The inflation rate is still high as compared to last year. The fiscal deficit has blown up to over 8% of GDP because of revenue shortfalls and increased pandemic spending. So what's behind all this chaos? How did things get this bad? One of the biggest reasons behind Pakistan's economic troubles is low labor productivity. Let us break that down for you. Labor productivity measures how much goods and services workers produce over a certain period. It's a crucial indicator of how well an economy is doing and how good living standards are. Now, from 1990 to 2018, Pakistan's labor productivity grew at a snail's pace, just 1.33% per year on average, according to the Economic Transformation Database. To put that in perspective, during the same period, Bangladesh managed an annual growth rate of 3.88%. India hit 4.72%, and China skyrocketed by 8.12%. So, why is labor productivity so important? Part of it comes from workers moving from less productive jobs, like agriculture, to more productive ones, like manufacturing or services. But even if we only look at productivity improvements within each sector, Pakistan still falls short. The annual growth in this area is a measly 0.73%. Meanwhile, Bangladesh, India, and China saw much higher rates at 2.11%, 3.38%, and 5.90% respectively. Now, why is Pakistan lagging so far behind? A big reason is that it hasn't taken full advantage of globalization, the wave of international trade and investment that has lifted many other developing countries. Being left out of global trade slows productivity growth, with huge long-term effects. Because Pakistan hasn't made the necessary reforms to boost productivity, policymakers have had to rely on external debt to create short bursts of economic growth. But here's the thing. Relying too much on foreign loans has landed Pakistan in a serious debt trap. According to the State Bank of Pakistan, as of January 2024, Pakistan needs to pay nearly $29 billion in external debt over the next 12 months. That's almost 45% of the country's expected income from exports and remittances. Back in 2011, this figure was just 12%, and now it's one of the highest debt burdens in the world. The last time Pakistan faced something similar was between 1998 and 2001. When debt servicing took up 40% of its dollar income. It might seem like Pakistan has hit rock bottom with nowhere to go but up. However, it feels like that rock just keeps sinking deeper. Another major reason for Pakistan's economic mess is political instability. Political instability has blocked the reforms needed to get the economy back on track. Since 1947, Pakistan has had a bumpy political ride. The country has bounced between military rule and short bursts of civilian democracy. The military has ruled for over 30 years combined, and even when civilians are in charge, the military often pulls the strings from behind the scenes. This constant tug of war means that policies and reforms can't stick around long enough to make a difference. For example, in the 1990s, there were efforts by the then government to privatize state-owned companies, but these efforts fizzled out when the government changed. Similarly, tax reforms introduced in the mid-2000s were later rolled back. Promises to attract more foreign investment have often fallen flat. Even deals with the International Monetary Fund, IMF, have gone off the rails more than 24 times because of political shakeups like pressure from other countries and setbacks in the fiscal and monetary policies. These disruptions slowed down the pace of much-needed reforms. In Pakistan, no single political party has been able to win a clear majority, so coalition governments are the norm. These coalitions often struggle to agree on major changes because each party has its own agenda. This has led to a frustrating pattern of economic boom and bust cycles. Here's how it works. The economy grows rapidly for a while, often fueled by borrowing and spending, but then it crashes into crises that require tough measures to fix. Take the period from 2003 to 2008. During this time, loose monetary and fiscal policies created a consumption bubble, but there were no reforms to boost productivity and exports. Despite all this spending, the fiscal deficit increased from 5.3% of GDP in 2009 to 6.3% in 2010. When the global financial crisis hit, Pakistan had to turn to the IMF for help. Fast forward to the 2018 election year, and the government once again adopted short-sighted policies to spur growth, leading to another crisis. Political interference also weakens key institutions like the tax administration, energy regulators, the State Bank of Pakistan, and debt management offices. Governance and power distribution companies, railways, and other public enterprises suffers because appointments are often based on who you know rather than what you know. Elite groups in sectors like agriculture, real estate, and retail resist reforms that would threaten their privileges. This distorts the economy and limits funds for important things like education, healthcare, and infrastructure. Deficit financing has increased because there's no political will to implement fair taxation and control spending. Let's talk about another cause of Pakistan's economic troubles: rising debt levels. Since 2011, Pakistan's external debt has nearly doubled, and domestic debt has skyrocketed six-fold. In 2024 alone, Pakistan faces a debt maturity of $49.5 billion, with a hefty 30% going toward interest payments, excluding bilateral or IMF loans. Consider that from 2011 to 2023, Pakistan's debt per capita shot up by 36%, reaching $1,122, while GDP per capita saw a decline of 6% to $1,223. This stark difference between debt growth and income paints a clear picture of why Pakistan needs to borrow more money. To illustrate, a newborn in 2011 inherited a debt of about 71,000 Pakistani rupees, whereas by 2023, that figure soared to about 321,000 Pakistani rupees, a staggering 4.5-fold increase. Why is this happening? Well, as we've explained earlier, the government has heavily leaned on borrowing to fund popular policies, subsidies, and struggling state-owned enterprises. Despite these efforts, tax revenues as a share of GDP have stagnated around just 10 to 12%, which is among the lowest in the world. In 2021, nearly 40% of all revenues went straight to paying off debts, leaving very little left for important things like development and social spending. Basically, Pakistan often has to borrow more just to keep up with the bills it already has. With a small tax base, rampant tax evasion, and inflexible spending habits, the fiscal deficit has consistently hit 7 to 8% of GDP since 2018. To cover these deficits, the government has been borrowing heavily from local banks, which has squeezed out the private sector and pushed up short-term debts with higher interest rates. This shift towards short-term debts, now accounting for over 45% of total domestic debt, means Pakistan faces greater risks of needing to constantly refinance its debts and being at the mercy of unpredictable market swings. These aren't just abstract economic problems, they're impacting people's lives every day. Take the textile industry, for example, the backbone of Pakistan's exports. Rising electricity costs have forced many textile producers to shut down, which in turn hurts the country's ability to make money from exports. And then there's the crackdown on illegal currency traders in 2023, which stabilized the official exchange rate but also scared Pakistani expatriates from sending money back home. not knowing if there are any risks involved. And then there's the Financial Action Task Force, FATF gray listing. The FATF identifies countries with weak measures against money laundering and terrorist financing in reports issued 3 times a year. When a country is placed under increased monitoring, often referred to as the gray list, it means the country has pledged to quickly address the identified issues within set timeframes. Being on the gray list has significant consequences for a country's economy and financial system. It can restrict cross-border transactions, make it harder for the country to obtain credit, and limit foreign investment. Beyond the economic impact, gray listing also damages a country's reputation and lowers its international standing. This has had a huge impact on Pakistan's economy, costing them an estimated $38 billion in GDP losses since 2008. While there was a sigh of relief when Pakistan got a temporary break from the list in October 2022, it's a loud wake-up call for better anti-money laundering and counter-terrorism financing measures. These aren't just problems for policymakers, they affect everyday life for millions of Pakistanis. Inflation isn't just numbers on paper, it's hitting families hard across Pakistan. For low-income households, necessities like wheat flour, rice, and cooking oil have become unaffordable luxuries. Parents are skipping meals to feed their children, and many can't afford vital medications for chronic illnesses. The desperation is palpable. Queues at subsidized food stalls grow longer, and more people are turning to charities or resorting to begging. Even middle-income families, though somewhat insulated, are feeling the squeeze. They're making tough choices about education, healthcare, and even everyday activities. Some are pulling their kids out of private schools they can no longer afford, while medical checkups and treatments are being postponed due to rising costs. The stress of financial uncertainty is taking a toll on mental health, leading to a rising sense of despair and frustration. We used to somehow get by on just 500 Pakistani rupees, about $1.75 a day. But now things have turned upside down. It costs us 1,500 rupees just to cook one meal, said a Pakistani. Our earnings barely cover a meal. How can we even think about sending our kids to school? The economic chaos and scarce job opportunities have pushed thousands to leave the country, taking risky and illegal journeys across rough seas and overcrowded, fragile boats. It's heartbreaking to hear that hundreds of Pakistanis lost their lives in June 2023 when an overloaded trawler carrying immigrants capsized off southern Greece. The ripple effects of inflation extend beyond households to businesses in the broader economy. Small and medium-sized enterprises are struggling to stay afloat as material and transportation costs soar. This has forced many to cut jobs or shut down altogether, worsening the unemployment crisis. With higher input costs, businesses are passing on the burden to consumers, driving inflation even higher. As prices continue to rise, urgent measures are needed to alleviate the burden on vulnerable households and to revive economic stability for sustainable growth. Before we get into the last part of the video, make sure to check out the link in the description for our best recommendation when it comes to further expanding our knowledge on a more personal scale. Speaking of urgent measures, a big part of why Pakistan keeps facing economic crises is because the government hasn't been able or willing to bring more people into the tax net. That means less investment in the formal economy, which is crucial for stability and growth. To get out of this mess, Pakistani leaders need to encourage private investment in key areas like infrastructure. Right now, there's too much focus on informal investments, especially in things like real estate, which hasn't worked out well. It's time for Pakistan to create an environment where its people want to invest in the country's long-term future, not just in risky stuff that doesn't help anyone. Formalizing the economy and attracting long-term investments are key to building a stronger, more stable economy over time. Currently, Prime Minister Shehbaz Sharif's new government is looking for another bailout from the IMF to deal with Pakistan's urgent financial problems. The IMF is ready to help if Pakistan applies for a medium-term plan. Pakistan should also look at ways to attract investments from pension funds and sovereign wealth funds, which are looking for good returns and are willing to take on a bit more risk. Making sure these investments are managed separately from regular government debt can improve how infrastructure projects are run. This could make them less risky overall, which is crucial when the government is already short on cash. In fact, using a public-private partnership model where projects raise money based on how well they're expected to do financially could give the economy the boost it needs. This approach not only helps build infrastructure, but also creates jobs, which is exactly what Pakistan needs during this tough economic time. To turn Pakistan's economy around, it's essential to separate economic decision-making from political influences, push through vital reforms, and rethink international partnerships. If you found this video interesting, make sure to hit that like button and subscribe to our channel for more in-depth insights. And if you're curious about exploring how economies around the world are shaping up, check out the video on your screen next.